Hi everybody, I'm Malcolm Harper, Managing Director of Tavistock Partners UK Limited, the Tavistock Partnership and Tavistock Partners Limited. The purpose of the meeting today is to introduce one of our financial advisors to you, a gentleman by the name of Mr. Haydn Morgan, and discuss with Haydn how he's dealt with his clients' investments during this really difficult time and how he personally feels about investing in today's climates. Hi Haydn.
Hi Mal, hi everybody. I'm Haydn. I'm a financial advisor with Abacus. I've been a financial advisor since the early 90s when I joined Pearl Assurance, working with various companies over the years. And I say I'm currently working with Abacus. I'm a chartered associate of the London Institute of Banking and Finance, and I specialise in pensions and trusts.
Okay, to start with then, Haydn, back in 2019, if I can take you back 1 year, which seems a long time now in investment world, you chose to invest a number of your clients in the Acumen Protected Fund during what was a rising market. And I just wondered why you took that approach.
Okay, well, the advice reflected the uncertainty that's playing out on the national and global level at the time. Brexit was a major factor. I was a little unsure what was going to happen with regard to that, as you know, lots and lots of people were. Trump was, posturing around the world, having various conflicts with the Chinese, etc. And I just had a bit of a sense that the bull market seemed a little bit too good to be true. So the thing you need to think about, or need to appreciate rather, is that I've got the clients I've spoken to over the years tend to be fairly similar, and most of them suffer great anguish if they lose money, but they're fairly impassive about any gains that they make. So it seems to me that once you've had a conversation with them about what could happen possibly, that they want to protect themselves, then they seem to like the idea of having some form of protection, particularly in times when there's uncertainty.
Okay, and has your opinion changed today with regards to that?
We're still in market uncertainty. Who knows? I mean, there's lots of companies out there that could absolutely benefit from the turmoil we've got at the moment, but there are lots that might fall by the wayside. Debenhams being a prime example of that. Who knows what's going to happen with the high street. There's lots of turmoil out there. We don't know what's going to happen with this virus. We don't know whether we're going to recover very quickly, very strongly. We do know there's a lot of cost involved. What's going to happen to tax, that kind of thing. So there's still lots and lots of uncertainty. I still think that we know that we're not out of the woods, and we don't know how it's going to play out. If you're quite a cautious person, then being cautious is something that you'll always do and always want.
Okay, so is it fair to say that your client's main consideration is preservation of their capital rather than gains at the moment?
It tends to be, as I said before, the anguish over losing money is much, much greater than the joy that a client seems to have when they make money. You go and see them, do a review or whatever, and talk to them about how the markets have done, how the fact that we got their asset allocation right, which means that they've made some money over the last few years or last year or whatever it may be. That's great. They like making money, but when it falls, they really don't like it at all. It's just human nature, I guess. There's a lot of behavioural science that suggests this has always been the case, and I guess we're just kind of switched onto it now.
A lot of advisors are saying to me at the moment that now is a good time to catch the bounce. Would you agree with that?
It's difficult not to agree with that, to be honest, but who knows how big the bounce will be, or whether it will be just a little, what they call a dead cat bounce, the dead cat bounce where it looks like it's going to recover, but then something else comes into play and it doesn't actually recover. And if you're a cautious investor, you don't tend to be gung-ho about these things. If there's a bounce to happen, a lot of people, the reason why companies make a lot of money by investing generally is that they buy up when the markets are bad and sell out when the markets are good. General people, our clients included, tend to work in the opposite way. In other words, they panic when markets are down and sell at the bottom, which is never a good idea, because you're going to lose money. Somebody else is going to make the money that you would have potentially made had you stayed in the market. But unfortunately, that's just human nature. And if a client wants to participate in the market, then capital preservation tends to be key. So my clients, particularly the ones that I speak to about this type of thing, I do have clients that want to take more risks, etc. But the clients that I tend to speak to about this type of thing seem to like the idea that they've got some kind of safety net.
Is there a danger then, Hayden, an advisor possibly imposing their mindset of?
Absolutely, I'm sure we all do that. I'm sure I do that as well. There's always a danger that that's going to happen. Advisors know what they're doing, so they know how the markets work. So it's very easy to impose your own point of view onto a client, both negative and positive. It could be that I'm being massively cautious with a lot of my clients by saying, stick with protected funds. We know it's not going to really participate in the markets it's coming out, because there's always going to be a lag, but we don't know if the market's going to fall. Now that's where I'm invested as well. So maybe I'm overlaying my concerns on my clients. I probably am to a degree, and other advisors might be doing completely the opposite and thinking, right, I'm gung ho, I want to get into the market. I want my clients to get into the market so they can get some growth out of these times. So we've always got to be wary that that's going to be an issue.
Have you got many clients that would look to catch a bounce, or is that more of a?
I don't think I've got many. I've recently done a piece of business with a guy who's waiting to invest, so it's not quite there yet. So he's waiting to see what the market does. But those people are very few and far between, in my experience, to be honest. People who are confident enough to be able to do that and know what they're doing. This guy has got a background in this kind of stuff, so he would have more of an idea, perhaps. Perhaps not more of an idea, but he'd certainly know his mind more. So he would be more inclined to act in that way and try and catch the market at a bottom.
Okay. A number of advisors say to me that because the protected funds are currently predominantly invested in cash, they're not an attractive investment at the moment for clients. What are your views on that?
I think that entirely depends on the client. So if a client is more inclined towards the lower end of the risk spectrum, then I think tentatively dipping your toe into the market by going to a protected type fund has got to be a good thing, because the way that these things work is as the market progresses and becomes better, for want of a better word, so as the market recovers, then you would expect, well, you wouldn't expect, it actually does happen, that the protected fund would then have a greater participation rate at the market. So you're getting in at a time where there's uncertainty, and there's an algorithm running in the background on these funds that just says, okay, if we hit this particular trigger, we're going to chuck some money back into the market. If that trigger's hit on the way back down again, then we chuck money back out of the market and go into cash. So if you're the type of investor that's got any worries about what's going on, if you're the type of person that's going to panic, then it's a good place to be, because you're not really getting the best of all worlds, but you're getting a very good kind of third way. You could say, I want to get into the market because it's at the bottom, which is a valid point, but we don't know whether it's at the bottom. We don't know whether there's going to be another spike in this virus, which would cause all sorts of economic problems in the autumn and maybe into spring next year. So we could be in the same position. Now, if you go into the market now, you might see that it grows. I mean, who knows what's going to happen, but you might see that it grows over the next few months, but then it could hit a wall again. Now, if you can cope with that wall, if you've got long enough to go before you actually need to access the money, then it might be a good thing. But if you're at all worried about anything, then you would probably tend to go into cash. But to go into cash would mean you would definitely miss out on what's going to happen in the future. So this is a good third way. These protected funds are a good third way to get into the market. It's predominantly in cash at the moment, but as the markets improve, then the money will come out of cash and move back into into the funds that it's invested into.
A lot of medical specialists seem to indicate there's every chance of a second wave of this sort of pandemic, especially in the winter. And again, that could have an adverse effect on markets. How do you feel that would impact on markets?
It will impact on markets, and it definitely will, because other firms are going to go down the pan. Who knows what's going to happen to the high street? The high street seems to be pretty dead now, doesn't it? I mean, nobody's going out now, but will they ever go back out again and shop in the markets, in the town centres of places? Who knows? But if the markets, well, if the virus continues in the way that viruses normally continue, then we could be in for more economic shocks. We could be in for more quantitative easing from the government as they're trying to bail out the economy. The signs could be quite bad, really. But who knows? I mean, there are experts out there who are giving their opinions on these things, but nobody really knows.
I assume that your client reviews have gone pretty well, especially if they are in the protected funds.
It's unusual to have a conversation with a client who says, "Thank God, I've only lost 5% of my money." It's incredible, really. In normal times, you think, "Oh my God, he's lost 5%." But I've had clients actually call me out going, "Oh my God, we are still in those protected funds, aren't we? What's happened with them? Have I lost 30% like it looks like the market's done?" And I'm saying, "Well, no, you've only lost 5%, which in the current conditions is great, And as the market gets better, which hopefully it will over the next, 6 months, 2 years, 5 years, who knows, your participation rate coming out of cash back into the market is going to be such that you will get a bit of that growth that's coming on. But if we drop again, you're going to be coming back out of the market and safeguarding yourself." They tend to like that. Okay. So review, it's been quite an easy story. Other reviews where they haven't been in the protected funds, not so good.
Which brings me on to, we also run active and passive independent portfolios in TP UK, as you know.
Yeah.
And a number of advisors have asked me, now they're doing the client reviews, doing a rebalance for clients is obviously a very important part of any review, especially if it's not managed on a discretionary basis. But they are concerned that that review could take them out of the market for a period, that rebalance, sorry, could take them out of the market for a period of time during really volatile times. How do you feel about that?
A rebalance, it depends on what you mean by rebalance, I suppose. If you're just tweaking around the edges and making sure that their asset allocation is right, then that's probably a thing that could go on at any time. If you're talking about massive changes, say a fund has fallen out of favour or a particular sector's fallen out of favour from an asset allocation point of view, and you're making quite a big change, then it could be argued now is not a good time to do it. Make sure it's still, the asset allocation model still fits within their risk profile, but maybe hold fire on actually doing anything until maybe we get a little bit of a return to normality before the autumn, I suppose, which is what most people seem to be thinking is going to happen. So if there's a point in the very near future where normality returns, then if you diarise to call those clients and say, "Look, I'm going to rebalance you now," then I don't think that's any problem at all, really. So it really depends on the client, depends on the asset allocation model, depends on whether or rather how far away from their risk profile it's drifted.
Okay.
And you just need to make sure that the client's aware.
Okay. So a rebalance for a client who say a 5, just to the latest 5 with some tweaks, you'd say is fine. But if you go into a completely different risk category, that may be something that's better time.
You have to make a call on an individual basis, to be honest. So when you're doing a review, see how far out they are. Bearing in mind that not all asset sectors have lost lots and lots of money. It's only really the equity sector that's done that. Whether that will change, who knows? But that tends to look like what the pattern is. So it could be that if they're a low risk investor, there's not really a great problem with rebalancing. If they're taking more risk, then potentially there might be. So it really does depend on the client and what they're trying to achieve, really.
One thing that's interested me is that we always do the risk profiling with our clients, where we ask the questions and you go through that process. And I think when you're in a situation where we are now, that's when you genuinely find out a client's attitude to risk more than the actual documents that we've used. Have you found the risk profiling system that we've used in the past ready you and your clients for this scenario, or is there more we can do?
I suppose what you need to always remember is that document is just the starting point. So you ask some questions just to kind of warm the conversation up. It's not black and white. It's not, I've answered yes to that question, therefore I must go into this particular risk profile. It doesn't really work like that. It's more about getting the client to think about what their actual goals are and what their concerns may be if things happen. It seems an awful long time ago now, but back in 2008, when the banking crisis was all about, people seemed to be more cautious at that time because they've seen what the market's done. And then spring forward 10 years, and they're not cautious at all. Well, not everybody, but a lot of people aren't as cautious as you'd expect them to be because the markets are buoyant. So the fact that we're in this crisis now will have a reflection on those risk profile questions that we ask. But I think that's just human nature. I don't think we'd ever change that. What an advisor's job is to get to the nitty gritty, to actually try and gauge exactly how much risk and how much loss they can actually stand. It's not really about capacity for loss, because that's a different thing. That's about whether you can financially cope with it. This is more to do with, from a behavioural point of view, whether you can cope with it emotionally. So, an advisor's job is to kind of tease that information out of clients. So our guys, I'm sure, are absolutely fine at doing this, and good at presenting how that document works, what it's trying to achieve, and not just ticking boxes and saying, oh, X plus Y plus Z means that you must be a risk profile 5. It's talking about what that actually means, and maybe going up or coming down depending on what the client actually feels in reality. So they're great.
Yeah, I think you're right.
Only a tool.
Yeah, you are right. Our guys do expand the document quite largely, which has been a real saving grace. There's always lots of comments on our documents.
Yeah.
But it's just quite interesting when I've seen some clients myself, when you actually talk to them about the drop in values, you can actually see the reaction to their risk level doesn't seem to perhaps correlate.
No.
So it's when you realise,
money, you panic.
Yeah, and I've learned a lot about some of my top end clients that I'd call the high risk takers. They're not risk takers, not really. I don't think. And now reality's dawned. We have had the conversations of when this is recovered, when this is back to normal. I think we need to go something a bit more where you should have been, because you're not really a category 6 or a category 5, etc. Okay.
Yeah, I've had these conversations too.
Have you had any clients, Hayd, actually want to surrender investments at this stage?
I haven't had any personally, although I did deal with a client who called the office, one of the other advisors' clients who was away doing something else, who was just in pure panic mode and just panicking about what's going on, think that they've lost lots of money, wanted to just drag it all out and put it into cash. So I had a look at what they had, and their portfolios included a number of things, including pensions. And I spoke to this guy, said, look, if you pull your pension out and your wife's pension out and your ISAs out, then what are you going to do with it? He said, well, I'm going to put it into cash because I'm panicking. So I said, okay, so you do know you can go into cash within these products without actually dragging the money out. Because once you drag the money out, you've crystallized the losses, but also because your money's invested in pensions, you're also going to pay a massive amount of tax on the withdrawals that you make. So you're really going to do yourself a massive disservice by doing that. So maybe we should consider doing some alternative stuff. What about going into cash, or going into something that's a bit like cash that can participate in the market and perhaps catch some of the future growth that's going to come along the line in a year, 2 years, 3 years, 4 years time, whatever it may be. So we started talking about protected funds. This guy was an ethical investor, so we started talking about the ESG protected fund, and he absolutely loved the idea of it. Now, had you had that conversation with him a year ago, maybe you wouldn't have. But the fact that we're in this crisis has crystallised his thought process, and he's thinking, I don't want to lose money. He hadn't actually, in reality, lost a great deal of money, but he preferred the fact that he had this safety net. And his original thing was just to drag it all out and chuck it into cash in the bank and pay loads of tax, which is, never a good thing to do. An alternative to go into cash, but you do crystallise all your losses. So again, this is a prime example of trying to make sure that the client doesn't lose all of their money. So we have gone mostly into cash because the participation rate in that ESG fund is fairly low. But he was going to go all into cash and never be able to catch any momentum that comes into the market in the future. So, it can work in some cases. For him, it seemed ideal. Hopefully, it will prove to have been that when we look back in a few years' time.
Okay. Do you have many clients that like the ethical sort of green strategy?
I've got a few, but not that many really. Now, whether that's my fault for not really asking the questions well enough, might well be. I think that this movement, this green kind of ethical way of investing has got to be the future. The world's choking, aren't they? So the fact that you'd invest in a cigarette company, a tobacco company, seems a bit odd. So I think most people are going to be thinking in that kind of way. How can we be sustainable? Little shops around the country are feeling a boom at the moment. Maybe the big retailers, the big companies are going to kind of fall off a little bit. I don't go to Tesco's anymore or Sainsbury's or anywhere like that. I go to the little shop just up the road. He's got a butcher and a grocer's there. It's absolutely brilliant. It's a little bit more expensive, but I don't want to go to the Tesco's and the Sainsbury's of this world now. And hopefully I'm going to continue to do that. Who knows, but hopefully I will. So I think that sustainability thing, the governance that you get with ESG funds and the social aspect of these things is got to be a big area in the future. My kids are massively into that kind of thing, as I'm sure yours are. So yeah, sure. Future generations, that's what they're going to want, without doubt. I mean, this movement with the greens at the moment is a massive thing and a good thing, really. Yeah. Okay. Hey, you're a sole trader, like many of our advisors under the umbrella. We're assuming we potentially may have a lockdown period of, say, up to 3 months. Yeah. We don't know, obviously. The difficulty for us in that scenario is that it stops us doing what we do best, which is sit on client sofas and talk to them face to face about their products and generate revenue from new products. What are your plans with regards to the potential loss of income over that 3 month period for your business? How are you going to try and deal with this? For me personally, I guess it's just a case of doing reviews, speaking to people who aren't due a review, just to kind of tee them up, because the people that I would have been seeing over the next couple of months won't have been seen. So I need to talk to them, I need to have a conversation with them and just work. Once we come out of this lockdown period, go and see them, talk to them about what they want to do, talk to them about what investments have done over the last few months, how this is all completely extraordinary, and how they can invest in the market, either catch this bounce that everybody's talking about, which may or may not happen, or go into more protected type environments. Who knows? But the main thing is to talk to them now, so that I can talk to them, actually get on their sofas and talk to them face to face, and make sure that we're doing some actual investment for them in the future. I think it fascinates me, really. This is a perfect opportunity for an advisor to really sort of
earn their corn. And clients may expect an advisor to sort of hide behind the sofa in these times, but all the successful advisors I know, this is when they have as much client contact as possible.
Yeah.
So I know
The technology we've got now. The technology
yeah,
that we've got now, like we're doing here, this conversation we're having over the internet is just fantastic. Having conversations with clients in this way is brilliant. You can, or they can see you, which is more important. They can see, you know, the whites of your eyes, if you like, and see that you're. It's a better conversation than just having a telephone conversation. It's better to see somebody's face and try and understand what they're, you know, what they're doing, what they're saying. It's much easier to read somebody's face than it is to listen to their voice and not see their face. That sounds a bit nonsensical, but I guess you know what I mean.
Yeah. One of the biggest things I think we've got to take advantage of here is, as sole traders or as business owners, we've all got something in common, is that we're exceptionally busy people.
Yeah.
And we never get the opportunity to actually stand outside of our businesses and take a look inside our business and really assess where we are.
Yeah, that's true.
This period for me has been quite reflective and quite good, because I am guilty more than most of running at things at 100 miles an hour and not stepping back and looking at my business and going, hold on a minute, what can I do better?
Yeah.
So I'm trying to encourage advisors, like you said, to use this 3-month window to really push ahead with the client reviews, get themselves a couple of months ahead so we can get the MiFID II paperwork out of the way.
Yeah.
Client reviews and what clients appreciate is not the MiFID II paperwork. The MiFID II paperwork requirement is what we have to do as an advisor.
Yeah.
They appreciate speaking to you, having a coffee with you, talking through their issues, and you reassuring them of X, Y, Z, whatever the issue may be.
Absolutely.
So if we can take this 3-month window and really look at our businesses, little things, we've got a number of premier clients paying us fees that are nowhere near what we need as a business to cover our annual face-to-face review.
Yeah.
We now have the opportunity to move them to basic, or basics to premier, vice versa.
Yeah.
The compliance department supported us by the removal of signatures. So we've now got only a signature needed for a brand new client, which is a client agreement, obviously, for data protection purposes. But other than that, we can do top-ups via this medium. We can do our reviews via this medium. If we can also get our CPD done, our testing done in this 3-month period, when we come back, we've got a clean desk, so we can just go and do what we all really enjoy doing.
Absolutely.
Seeing clients, talking to them about things, opportunities, investing. A, we'd have a bloody good time for 2 months. B, we might regenerate that revenue that we've lost over the 5-month period.
Well, I think,
and this is going to be vital.
I think that would have happened. You know, that business is still there. If it was going to be there over these next 2 months, if you would have found it over the next couple of months, then it's still there. So, you know, you can't ignore that. And clients want to talk to us. You know, they know that the market is in turmoil. They watch the news. They think their investments will drop by 30% because they see what the FTSE's done. So to just call somebody, send them an email, send them a text message. Text messages are brilliant, to be fair. Or go do this Skype thing or Team thing or whatever this is. And you know, it's a time to talk to your clients, isn't it? It's a time to make contact, let them know how good you are so they can tell their friends about you as well.
Yeah, definitely. This is definitely a time to get in front of clients in any medium you can, reassure them, let them know the minute the lid is lifted and we're back out there, we'll go around for coffee and sit down with them and have a chat and see them properly. Because this is good. This is a good medium, and it will work, especially with clients, especially the younger generation. But
yeah,
it's hard to beat being on the sofa with clients and being able to get the proper emotion across of what you're trying to explain. But no, I think it's really important that businesses look, yes, we're in a lockdown situation, but we really do need to come out of this fighting and come back with a bang.
You've got to view things like this as an opportunity. So an opportunity to get rid of all the stuff off your desk that you normally kind of put to the back, and try and make yourself leaner. And make sure you've got some appointments in your
Good.
diary in a couple of months' time. Let's be honest.
Excellent. Well, unless you've got anything further to add, Mr. Morgan, I think I'm done on my side.
How about pay
Anything
rise?
you want to cover off?
No,
Maybe, if we come back with a bang, you never know.
We've got to come
Thanks,
back
mate.
with a bang. We've got to come back with a bang.
Yeah.
Otherwise, you know, this time we're in now is an ideal time to take advantage of. If we don't, we're going to struggle as a business and as just individual advisors as well with our own businesses.
Yeah, definitely. One thing that hasn't stopped, the FCA fees, the false fees, the PI insurance, it's all gone up. It's all there. It's not going away.
No.
We can't afford to have a 3 month loss of revenue in any business, from a sole trader to the group.
No.
And we really need to get together and pull together and definitely come back fighting. And I know we will. We're good guys. We're definitely one of the best teams around. The way the guys have supported us with the cuts and things we've had to make for the short term has been fantastic. We're all on the same page and we're up for the fight. So that's about all we can do. But great stuff. Thank you very much, mate. I do appreciate that.
No problem. Wash your hands. Don't touch your face.
Cheers. Stay safe.
Ta-ra.